G'day everyone, Chris Carlin here, masteryourmoneynow.com.au, helping you take control of your finances from the comfort of your very own home. Now, I wanted to answer a question that come through to us at Master Your Money Now. They are looking to save for their first home, and the question that they asked is, should they save a 5% deposit or a 20% deposit? Now, it does depend on your personal circumstances, but let's just have a bit of a discussion about that. So, the reason why we've gone 5% or 20% is because of this thing called Lender's Mortgage Insurance, or LMI for short. So Lender's Mortgage Insurance is an insurance that protects the bank, not you, in case that you're unable to make your repayments. Now, if you have a deposit of less than 20%, you've got to pay Lender's Mortgage Insurance. However, if you have a 20% deposit, no Lender's Mortgage Insurance is paid, okay? So, now, Lender's Mortgage Insurance you can generally build into the loan, but just to keep things simple, let's just assume that Lender's Mortgage Insurance is, let's call it 3% of the value of your first home. So, I'm going to play two scenarios to you, and I'm going to assume that you're able to save 20 grand a year, and the value of your first home that you want to buy is $400,000, okay? Let's just work it. So if you've got saving 5%, after year one, you both save $20,000, okay? Whoop, $20,000, okay? Let me just rub that out. So, now at year one, the person saving 5% has already got their deposit. They just need to save a little bit more for their Lender's Mortgage Insurance, but generally that can be factored in. But let's just assume they're able to purchase their first home after their first in 12 months, okay? But the thing is, they've had to pay an extra 3% of $400,000, which is $12,000 in Lender's Mortgage Insurance. Extra 12 grand, that's pretty expensive. Whereas the one saving for 20%, year two, they've now saved 40. Year three, they've now saved 60. Year four, they've now saved 80,000. They now have a 20% deposit and they've saved $12,000 in Lender's Mortgage Insurance. In addition, you could also argue because they've got only an 80% loan, 100% less 20%, they've now got a smaller mortgage, whereas those with 5% have got a 95% mortgage, so they've got a bigger mortgage. 20% smaller mortgage, 95% bigger mortgage, okay? So if you look at it just like this, it probably makes sense to do the 20% option because you save yourself 12 grand in Lender's Mortgage Insurance and you're also going to have a smaller mortgage at the end of the day as well. This is all good in theory, but there's one assumption that we haven't talked about that changes the calculations quite dramatically. And the assumption that we've made in this scenario is that the value of your home doesn't change, which, let's be honest, is pretty unrealistic. Property prices have been going up for a long, long time. Yes, I know we've had a bit of a struggle recently, but most of the time, property prices have been going up. So let's have a look at this scenario again, but let's assume that prices are increasing by 5% per annum, okay? Home price increase by 5% per annum, okay? So, year one, 20 grand, the 5% purchase their first home, let's go for $400,000. There's going to be a lot of numbers in this one, so just bear with me. Year two, that property is going to go up by 5%. That property is now worth $420,000. Year three, property goes up by 5% on the 420, so it'll be $441,000. Year four, the property has gone up another 5%, my apologies, and because this is quite complicated to figure out on the top of my head, let's say it's worth $465,000. So the person that purchased at 5%, it's just made 65 grand in 3 years. Because it took them 12 months to buy it, 4 years later it's now worth 465. But the other thing is, all of a sudden, this 80 grand is not going to be enough, a 20% deposit, to purchase a $465,000 loan. You're going to need, it's going to be about $92,000 to purchase that purchase that sort of home for a 20% deposit. You've then got to save another 20 grand. So now you're up to 100 grand, and spend another year for this property to go up to, and by that time the property is going to be worth about 485. So you'll just sneak in, but you've also lost 85 grand in capital value in the process. Of course, it really does assume what property prices are going up in value, and that's something that we don't know. We don't have a crystal ball in regards to what property prices are going to do in the future. But what I will say is this: if you look at it as just an expense saving exercise, then yes, a 20% deposit is your best option. But if you look at the capital growth here, the person that got a 5% deposit and got on the market straight away, yes, they paid an extra 12 grand in lender's mortgage insurance, but they also made $65,000 in capital value, 65 grand while they slept. And they didn't have to pay, like, you know, with this particular person, they're probably still paying rent, or they're living at home with their parents. You know, there's none of that. They've been able to live in their first home. They've paid down their mortgage for the last 4 or 5 years, and they're able to really think about their next home, because they've now got 65 grand in equity that they can use as a deposit for their next home. I think the message is up to you how you interpret it, but I think it's pretty clear which the best option is. If you want to discuss this in more detail, by all means, go to masteryourmoneynow.com.au/get started and book in your free 30-minute consultation with myself or one of our specialists, and we can have a chat regards to your options and your situation, because every situation is different and we can tweak the numbers based on your circumstances. I hope you enjoyed this video. If you did, please share it with your friends, family and colleagues who might benefit from this information as well. My name's Chris Carlin from masteryourmoneynow.com.au. Looking forward to seeing you next week's Whiteboard Wednesday.